Hi friends, this is Ankur welcoming all viewers to the session on profitability ratios. This is a relatively easier aspect wherein we are going to talk about how profitable the firm is. I mean, there are some parameters, there are some ratios that will talk about the profitability of the ratios at different levels, number one, and from two point of views. One is the management's point of view, the other one is the capital provider's point of view. Okay, so the management's point of view is very simple. Let's look at that. So these are the few ratios that the management will calculate to check the profitability. Fairly simple. All are being taken from the income statement here. Okay, so let me just take another pen. Yeah, so all have been taken from the income statement stroke P&L account. All the denominators are going to be revenue because that's the base. That's what the credibility of management is. How much sales can they generate? And there are different levels. Remember that multi-step income statement where you are able to find out the gross profit first and then EBITDA, then EBIT, which was your operating profit, then your profit before tax, and then profit after tax. So each of these profitability levels could be just in context to the revenue. Okay, fairly important. Out of these, one of the relatively important ones are these two: operating profit margin and net profit margin. Okay, important aspect here is any non-operating income is not going to affect your operating margin, but obviously will be included in your net profit margin. So that's what management is worried about: how much profit have been able to be generated. But there is a different group of people who have provided the capital. They're not bothered how much sales, how many units does the business sell. What they are interested in, what is the return that the business has been able to generate on the capital that they have provided. Okay, now let's talk from all. So there are how many capital providers are there? There are equity, debt, and preference. So there are different levels of the ratios. One, we take all three put together. So whose capital are we taking in the denominator? Equity, debt, and preference, all three. So total capital employed. And the numerator that we are taking is the return that the business has been able to generate for all the three. So that's, I want you to write here apple to apple. The denominator and numerator have to be apple to apple, in the sense that whosoever's capital is being taken in the denominator, you have to take the returns for those group of people only. I cannot write PAT here because PAT does not belong to debt. The payment for debt has already been made, which is the interest. So you have to take the level of profit which includes the returns which the business is being able to give to that particular provider whose money is put here. Let's talk about return on equity. And like I had mentioned earlier, the equity will always include preference. So here you have your equity plus preference, the book value, and what is the return that the business has been able to generate for both of them. Now here we cannot include EBIT because EBIT also includes the debt. So therefore, from EBIT you got to deduct what you have given to the debt holders, which is the interest part, pay the taxes, and what is left is your PAT. Very critical and important. Apple to apple. But if someone asks you how much is the return that only common equity has been able to generate, I'm going to take only the common equity, and even from PAT I'm going to deduct the preference dividend. So basically this is the same as numerator of EPS, earning attributable to common equity shareholders. Okay, so you have to maintain apple to apple in that sense. There's another base on which this could be calculated, which is the base of the total asset. So the total asset is also honestly almost like the equity plus debt plus preference, because it's all three capital providers put together. They help and buy the assets of the firm. And in the numerator you have the PAT. Now the challenge with this kind of a ratio is it is logically incorrect. logically incorrect, but it is very, very convenient to calculate. Imagine, it is so easy to calculate the total asset because this is one of the totals of the balance sheet. And it is so easy to calculate net income because this is the bottom line. The last line written on the income statement is your net income. So this is the return on asset has evolved as a very convenient, quick, and an average, approximate way of judging the profitability on the asset utilization. But the better and a logical way to understand that is whose money has been spent to purchase these total assets. It is equity, debt and preference all put together, including the debt. So it is not the PAT but the EBIT that should be used as a better numerator in context of the total asset. So, we have to give another name, so we are calling it as operating return on asset. Okay. There is something called as net operating return on asset, which is equal to EBIT 1 minus T divided by EBIT 1 minus T divided by total assets. EBIT 1 minus T divided by total assets. Okay. Another important point here, which was there in the activity ratio as well. Why are we taking average in the denominator? Why are we taking average in the denominator? The reason for that is these ratios are mixed ratios. What are mixed ratios? One of the aspect is coming from income statement and other aspects is coming from the balance sheet. So what is the problem? Well, the problem is in terms of the time period. The balance sheet is at a point in time, whereas income statement is during a particular period. So it's not apple to apple to compare a during the year transaction with a point in time figure. The same problem doesn't arise in liquidity or solvency because both are at a point in time, both are from the balance sheet, so both are at the same time apple to apple. But these are not at the same time, they are very, very different. Clean the board a bit for you. Yeah, so if you talk about average total, if you talk about the capital, it might be on the 1st Jan very differently and it might be on the last December very differently. So if you recall your EPS, earning per share, there also the numerator was earning attributable to equity share and there also the denominator used to be weighted average number of equity shares. So why was there a need to weighted average the equity shares? Again, because of the same logic that it was a mixed ratio. Okay, the same aspect was there in the activity ratios also. Here, if you see, sales is a income statement figure and total asset is a balance sheet figure. Again, it's a mixed ratio and therefore you have to average out the total asset. That's going to be the structure, all throughout in the activity ratio. Actually, it's not a problem of an activity ratio or a solvency ratio. No, it is a problem of a mixed ratio. So wherever you see a mixed ratio, you'll have to average out the balance sheet number. Maybe it is in the denominator, maybe it's in the numerator. Please don't understand that it's always the denominator that is average. No, it is always the balance sheet number which is averaged. Okay, that is something that you have to understand. So I hope that this small session on solvency, session on the profitability ratio is clear. I look forward to speak to you in the next session, on the dew point, which is going to be very, very important from an exam standpoint. So stay tuned.